What's going on, guys? Welcome back to the channel. Today we are talking about Home Depot. Now, they just recently reported their earnings. It wasn't looking too hot. And this is one of those companies that are getting sideswiped by inflation. So sales have gone down. They're ultimately trying to raise wages for their employees, as well as they've increased their dividend by 10%. It's a very interesting combination. However, upon the missed earnings, stock price is down by around 5%. But what does that mean for potential investors like you and I that are looking to potentially get into this company? Well, here's the thing, folks. Them increasing their dividend is actually pretty good because, listen, that indicates to us that they have some balance sheet strength. And it's quite evident here. I have it loaded up in the stock spec software if you want to get your hands on the software, folks. Follow the links in the description box below. So take a look at this, guys. Their dividend yield right now is 2.53%, and the dividends being paid out is $7 billion. Their average 5-year free cash flow comes out to be $12.4 billion. So, and the trailing 12 months free cash flow has been $10.16 billion. Anyways, the numbers check out that they can easily pay out that dividend, no problem. A 10% increase won't hurt them that much. They'll be able to weather this potential storm that's coming. The last year, I guess, for Home Depot and Lowe's for that matter, the home improvement stores, have seen a major influx of people just doing home repairs because ultimately you were most likely at home. So you probably notice all the things that need to get fixed up. So they took advantage of that, and now we're seeing obviously the high inflation affecting them, and people just not doing as many renovations. So it's a double one-hit-two combo where people are now saying, well, renovations are pretty much done. Inflation's already high. Why should we invest more into the house when we have other costs to take care of? So with that in mind, let's see what the company's doing right on a financial basis, and we're grading this company a 7 out of 10. So from a balance sheet, income statement, and a cash flow statement, it's actually pretty solid. It's a pretty solid company. They're only getting knocked in 3 different categories. One being their current ratio sitting at 1.39, which isn't the worst thing, folks. That just means that we're looking for companies that have a current ratio of 1.5 and higher. But ultimately, they do have enough assets on hand to cover those liabilities. They have a very poor return on equity average, sitting in the negatives, which is very surprising for a company like this. And their debt to equity ratio is in the negatives, meaning a negative shareholder equity. However, the other things that they're doing right is looking pretty good. They have a low price to earnings ratio on average, sitting below 22.5. On average, it's been 21.78. So you're paying for a much more fairer multiple for those earnings, which is something we like to see. Their EPS has been growing over the last 5 years, which is amazing. So if you've been holding on to this company, that is great. Their share dilution actually, in conjunction to that earnings per share growth growing, their share dilution is down by 5%. That means they've been buying back shares. So that's something you want to see, folks. You want to see a company either keeping the share count the same, or buying back shares, which is the better option. The net income is up, free cash flow is up, return on invested capital is sitting at a whopping 49%. On average, on the trailing 12 months, it's 45%. Ultimately, I look for companies that sit at a return on invested capital average, let's say 10% or higher. That's fairly conservative, fairly healthy. But 49 is massive for a company like this. And the revenue growth is up by 10% over the last 5 years. That's that's on an annual basis. So you clearly see there's a lot of balance sheet strength for Home Depot. Now, ultimately, this isn't their first rodeo. Obviously, it's very cyclical when people start doing home renovations, because here's the thing, folks. You're going to update your house. Now, the next time you might update it might be, let's say, 5 years down the line. So it's a very cyclical process. So that is something to keep in mind. That's 5% decrease in the stock, obviously not a huge drop, is a bump in the overall scheme of things. So ultimately, what should we be paying for this company? That's the next question. We see that there's a strength in the balance sheet. We see that this company is probably able to weather the storm that's coming up with its high inflation, recessionary scares and stuff like that. Well, I have this loaded up in the price analysis section here. I've done some numbers here on a 10-year evaluation. So this is forecasting for the next 10 years. I've used some conservative metrics like revenue growth being from 5 to 7%. From a conservative, moderate, and aggressive category, I kept the profit margin and the free cash flow margin very similar to what they've showcased over the last 10 years using the historic numbers that they provided us, as well as the price to free cash flow and PE ratio sitting at conservative numbers being 14, 16, and 18 with the price to free cash flow, and the price to earnings ratio sitting at 15, 17, and 19. Desired return of 13%. We'll click calculate. And if you are enjoying the video so far, folks, hit that like button and subscribe button. So the current price at the time of recording this video is $302. We're going to see what the software spits out so we'll know what we should be paying for this company today. So comes out to a whopping, whoa, look at that. Look at that. The price changes from 302 to 308, but look at that average calculation, guys. Average calculation comes out to be 302.42. Guys, we are pretty much there. We are pretty much here with that little price decrease at fair value for Home Depot. And this is using some conservative, really conservative metrics. This is like very slow revenue growth over the next little while with conservative price to earnings ratio. On the low end, we have $233.21, high end $375.50, with our discounted cash flow sitting at $312. So ultimately, folks, coming down from our 52-week high of $347.25, you are looking to get this company right now pretty much at fair value. I mean, if you agree with these aggressive numbers here, this is a potential buy for you all day. However, I like personally seeing the numbers in between my conservative and moderate average. That I like to see some those numbers somewhere in there. That just makes me feel better. But 302 and 303 being that current price, we are pretty much almost there, folks. So if this price drops down a little bit more, that actually would look a lot more attractive. And I think, you know what, in the tail end of 2022, let me zoom in here, we actually hit that. We were pretty much almost there. In September 2022, we were at 266, and the 52-week low was at 264. Yeah, pretty much almost within that range. And now the stock price has ultimately increased over that time period, but it's looking pretty good. You know what? If I would potentially get into this company, not saying I would right now, I feel like there's other ventures out there that look great, but seeing this price, I would put this on a watch list, see how low this price actually goes. And yeah, this might be something that to pick up. Ultimately, dividend investors are probably looking more so towards this stock because pays out a pretty healthy dividend. They're easily able to cover that dividend. They are just getting a little bit knocked due to the inflation and their earnings miss. However, I have faith that this is a company that's going to be around for quite some time. I don't think Home Depot is going away, as people are buying more homes. New homeowners are wanting to renovate their homes. This is just a cyclical thing that's happened. So they'll be able to weather the storm, and I think if this price drops a lot more, it'll look a lot more attractive. Anyways, folks, if you enjoyed the video and you enjoyed the software, hit that like button, subscribe button, follow the links in the description box below. I will see you in the next one. Thank you so much for watching, and I apologize for not releasing a video over the last little bit. Got busy with a lot of things, but no excuse. But more videos to come, and I'll see you in the next one. If you enjoyed this video, make sure you don't miss out on this stock right here. Now, I believe this might be the potentially best investment going forward in 2023, given everything that's happening.